Good afternoon, everyone. Thank you so much for joining us for our March Lunch and Learn. We will be hosting these Lunch and Learns on the last Wednesday of every month at 12 o'clock. So we hope you can spend a little time at your lunchtime and come join us in the future. Today, Graham will be speaking for about 15 to 20 minutes. And at the end of the call, we'll have a Q&A time. So if you do have something while Graham's speaking, you can type in the Q&A section of the chat box any questions you might have, and we'll try to get to all of them at the end. So without further ado, I'm going to turn it over to Graham.
Awesome. Thank you, Jeremy. First off, I want to thank everyone for being on the call. Thanks again for taking time out of your lunch schedule. We always try to make these pretty timely to topics. And one thing that keeps popping up, conversations that or questions that I get, is should I stay or should I go? Is the market overvalued? Are we going to get a pullback? Are we going to get a correction? So I just want to spend a little bit of time today just talking about the past. Does that give us some idea or clues for the future? So let's go ahead and jump in. So if I look at, what could happen? Well, simple enough. And one of the resources we use, they look back from 1930, and they found that per every decade since 1930, if you missed the 10 best days, you significantly underperformed or had significantly lower returns instead of just kind of waiting it out and having the ride, if you might, a little bit of the roller coaster. If we go a little bit further and we look at breaking those down into some statistics. So we look back at 1930 and we found if investors missed the S&P's 10 best days during each decade, the total return would stand at 28%. Well, in turn, if they would have held steady and ridden out the ups and downs, look at this number. It's 17,000%, over 17,000%. Now, it's never comfortable to ride out these ups and downs, but that's a part of investing, right? You got to take the bad with the good. And if you think about it, you're up 80+% in the S&P index since at the bottom of last year, from the S&P to the top this year. That's a big round trip. So I think it's reasonable to expect the market to have some pullbacks, and you should expect that within your portfolios. Like it, never said you had to like it, but it's something that I think is reasonable to expect. If we kind of look at, kind of what happens, when you see the market really flush out, right? These big drop days, think about it. A lot of times they're led by some pretty good pops in the market. So there's a kind of an old saying or old, thing to think about when we're thinking about investing is that you want the markets to go up like escalators, right? So maybe go up a little bit, pause, up a little bit and pause, so we don't drop like an elevator. So think about it, what we're asking the markets to do and what you would like to see in your own individual investments compared to the market as a whole. You want a chance for it to have positive performance. You want an opportunity to relax, take a deep breath, digest those positive gains so it can set itself up for another rally. And that's a sign of a healthier market. Again, you need other factors in place, but it's a general trend of the market that seems to be healthier and holds up to a longer bull market rally, just so we don't drop like an elevator, right? So if we kind of jump into that a little bit more and explore some statistics, if we look at the 10-year returns for the S&P, they've only been negative 6% of the time since 1929, only 6% of the time. So really the majority of the time, and I know we're just illustrating the S&P, but it's a pretty broad index. That's not many times that it's had a negative return. If we look back since 1920, the S&P index has an average, or it's recorded an average pullback of 5% 3 times a year. So that 5% is a pretty normal, again, not something that you might not like, but a pretty normal pullback or digestion of maybe some rallies. We've had a 10% once every 16 months, so just over a year. And we've had a 20% bear market, or what they're saying, a plunge, every 7 years. So think about it. In 2020, the S&P was down 34%. From that trough to peak this year, we're up a round trip of around 80-odd%. So is it reasonable again to expect some pullback, digestion? Absolutely. Now, lastly, keep in mind that when we think about performance and volatility and what to expect and everything, it also, what type of volatility you're going to have in your portfolio is also the makeup of your portfolio. You might hear a lot, or if you're a client of ours, you hear a lot that we're talking about risk management strategies. How to make sure that you're not taking on more risk in your portfolios, your investments, than you're comfortable risking. And we kind of think about it as speed limit signs here in our office. We want your speed limit in your household, your comfort level with risk and volatility, to be the same or complementary within your investments. And I think that's pretty reasonable, right? So when you go through those periods of volatility that we know we're going to have, you're always making good business decisions and not emotional decisions, all right? Another way to really mitigate making an incorrect or emotional decision is make sure you got a plan in place. If you know where you're at, you know where you're going to go, and you understand the risk reward to get there, you're more likely to stay on track, correct? But if you don't have the plan, or you don't understand exactly the ebb and flow, or it's not within the comfort level or the level that you're comfortable, then you're more likely to make emotional decisions. And that's what we don't want to happen. It's kind of the saying that I've thrown out there: when you're in the middle of a battle, right? Because the war is our approach, our horizon in life, our financial future, right? But when we're in that battle and the bombs are dropping, the bullets are flying, the last thing we want to do is trying to figure out what direction we're going to go. So we want to have a plan of attack. Now, we know we might have to make adjustments and changes, but ideally, it's not something you want to do while you're in the middle of a battle amongst your financial war, if that makes sense. My calendar is going to pop up from time to time. If you got any questions for me or any one of my team members, we're here for you. Go ahead and hit that calendar, and we'll set up that time either for a virtual call, phone call, or I know this is crazy, we're actually meeting in person if you're comfortable. So we'll meet you wherever you feel comfortable. And then secondly, we always want to think about managing to that plan. Again, it's great to have a plan, but the plan is only good if you manage to it. And I teach a lot of retirement planning in classes and courses, multi-day courses in schools and universities around town. I know many of you have had the opportunity to attend. And you're going to hear me all the time talk about plans, manage to your plan. Know where you're at. You have an idea where you're going. You know you're going to have twists and turns and bumps. Expect it. And you're going to have a really solid idea and expectation where you're going to end up. Then we want to keep a good balanced approach. Listen, if you are all focused in on the tech trade, the shutdown pandemic trade that created that high level of productivity so we could work outside of the traditional office, we could work from anywhere if you might, you know what? That side of the trade has really been underperforming. We have massive valuations in those stocks that can be very challenging to justify. So if you look at the market and you say, okay, what has really had some of the biggest pullback to date from last year to this year? You know, we're really seeing it in that shutdown technology trade with those high multiple, high price to sales. And if you're really laden or you have a large focus in those areas, then you got to expect more volatility. You got to take the pain to get the pleasure, right? So it's always appropriate to make sure you got a good balance. You got to think about what worked in 2020, but then we got to think about, okay, 2020 is behind us. What's going to work in 2021, 22, 23, so on and so forth. So we're always trying to think ahead, but we keep our eye in the rearview mirror. But we don't manage in the past. We try to manage for the future, if that makes some good sense. Then a good old-fashioned diversification. Don't want to be all in small caps or mid caps or large caps or U.S. or just international. We have to understand that different areas are going to perform differently at different times. When your risk appetite is high, maybe in the market's risk appetite's high, you know, like with the cryptocurrencies with the tech stocks with high multiples, high price to sales, you know what? That momentum might work for you there. But when it's not in favor, it's really going to really negatively affect your portfolio, maybe for the short, possibly for the long term. So we want to protect that through diversification allocation. We know we're a great house financially, the United States, in a really big neighborhood of the world. But we also have to be real and understand that different areas around the world, Europe, emerging markets, Latin America, might have different opportunities and perform differently. So we want to think about that, small, mid-cap, large as well. Growth versus value. We talked about in a previous Lunch and Learn on growth versus value. So again, other areas that you can diversify in. All right. And then we want to manage to the risk score. We say risk score, it's what I talked about earlier. It looks like a speed limit sign. And we really think it's really important until you really understand what risk and reward means and understand that everything has risk. Everything does. From the money markets, the CDs, to stocks, to bonds, real estate, gold, crypto, everything has risk. We just got to define that risk and make sure you're comfortable with it. So that's what we mean managing to a risk score. Let's set that speed limit that you're comfortable driving and ensure that your portfolio is driving at the same level. So when you go through these periods of volatility, which inherently we know will happen, you know how to ride them out of it. Again, my calendar is going to pop up. Don't hesitate to hit that, and I can always jump in to what we're talking about in a good bit more detail. Hey, Jeremy, why don't we go ahead and open it up to a little Q&A.
Okay. Thank you so much, Graham. It looks like we had a couple questions come in. The first one was, do you see a market pullback or correction for 2021?
I do. You know, as we talked about, 5% corrections average about every 3 times a year, 10% every 16 months, 7 years for a 20%. Listen, anything could happen, right? But I would say, listen, we've already had a good pullback in the NASDAQ. I'm not saying it's done because usually if we try to put a marker in the sand, we're probably going to be incorrect, right? We don't have that crystal ball. But, you know, look at how far these indexes have rallied. Look at what you own and how much they are represented within the funds you own, the ETFs or the indexes, not to mention the stocks and the sectors they're in. And that'll give you some idea. So I guess long story real short, yeah, I do. We're already going through a little bit of it. It could get a good bit worse before it gets better. But again, as long as you have the plan, you can ride it out. Great question.
Okay. So a follow-up question to that one came in and says, you know, in anticipation of a market pullback, do I need to make any drastic changes in my portfolio?
You know, that's an excellent question. And I'm going to key in on one word you said, drastic. Absolutely not. If you have a plan and you're managing to the plan, you know you got your emergency fund set aside, you got your long-term, your short-term, you understand your risk, you got your plan in place, your map, if you might, then no, you don't make drastic changes. It's like the statement I made about when you're in the battle and the bombs are dropping, and the bullets are flying over your head. What do you know, is that the time to make drastic changes? I think not, right? That's when we want more of a level head and we want to make good business decisions to get us out of that situation, right? Now, should you not make some adjustments and changes? Well, I'm not going to say that because every situation is unique and you might. But drastic, no. I think if we do our work ahead of time, and hopefully you're working with someone, if you're on today and you're not working with us, I know our clients are probably saying, yeah, we already have these plans in place. But if you've done your homework at the beginning, you're not going to be apt to try to make drastic changes in the middle. Great question.
The last one that came in, it looks like she said that this is her first time on one of these calls, and she wanted to see what your philosophy was, or the company's philosophy was, on investing.
Well, I think I'm laying it out a bit. You know, I put it this way: we got 2 ears and 1 mouth for a reason, right? So it pays for us to listen to what's important to you. What are your goals, objectives? What are your challenges that you're having in your financial lives? And let's create a plan and strategy to achieve those goals and objectives in what we call a holistic approach. And when I say holistic, you might say, well, what do you really mean? Well, I kind of mean taking a big picture approach to everything or all aspects of life, right? So when we talk about holistic planning or all culture here of the holistic approach, we want to think about investments. Sure, they're important. They're the gas that fuels your car to get you down the road, right? But they're not the most important thing. We want to think about taxes. We want to think about estate planning. We want to think about retirement planning, so that next stage of life and the cash flow needs or your needs during that period. We want to think about those risk management strategies. How do we protect what's important to you, not just with your investments protection, but also your home, your car. And we want to make sure everything's going down the road, everything's represented on your map, your wealth management plan to get you to where you want to go. So if I had to sum it up in one word or two words, it would be wealth management is our culture here, looking at the total approach. Excellent question.
I don't think I have any more questions this time, Graham. You want to wrap it up?
Yeah, absolutely. Thank you all again for being on the call. Again, we're always trying to hit topics that we think are going to be timely and of interest to you. Hit my calendar, myself, any one of my team members are here to talk to you from our insurance team, legal team, financial and accounting. We're here for you. We look forward to seeing you on our next call. And again, my calendar pops up, just hit that and we'll reach out and have a conversation. Thank you and have a great afternoon.